Hello and welcome to Trading 5 Talents. In today's video, we're talking about out of the money, at the money, and in the money options. But before we begin, I just want to say I'm not a financial advisor and this is not financial advice. This content is for educational and entertainment purposes only. Any trades I mention are not trade recommendations, but either an example trade or a past trade that I've made. So please don't enter into any trades you see here. Now let's get into the video. The first thing we'll look at are out-of-the-money options, abbreviated OTM. Now, a call option is out of the money when the strike price is above the current share price, and a put option is the exact opposite. A put option is out of the money when the option's strike price is below the current share price. We'll take a quick look at the options chain so you can see what this looks like. All right, so I'm over here in Robinhood, and again, if you want to join Robinhood, you can go ahead and click on the affiliate link down in the description. You and I would both get a free stock when you join. If you don't want the affiliate link, just go to robinhood.com and sign up. This is the broker that I use for trading the wheel. There's zero commissions, and so I enjoy the interface, and I've been using it quite frequently for the past few years. But let's look at what these options chains would look like so you can see what is an out of the money versus in the money option. So I'm just going to select one of these as the 100 most popular. We'll take a look at Apple. This is a very well-known stock. So I click on Apple, click on Trade Apple Options, and then I'm going to scroll down to the current price, and that's just by clicking on the share price. And so we're looking at call options right now. We're not concerned with buying or selling. We're just looking at call options because with the call options, remember, any option in the options chain that has a strike price higher than the current share price, so 146, 147 and up, these are all out of the money. These are all out of the money. Now on the put side, if we click on put options, it's the exact opposite. Anything below the current share price are all out of the money. All right. Now, what does this mean, out of the money? So that means these options, they only have what's called extrinsic value. And that's composed of a few things. First of all, the time left in the options contract. Remember, these options are they're like coupons, and they're only good for a certain amount of time. That is, they expire at a certain date, and that's referred to as the expiration date. So the more time they have until the expiration date, the more value they have. It's referred to as extrinsic value. And also the implied volatility of the underlying and the option itself. The more volatility an option has, the higher the cost or the higher the premium of that particular option. Now, in contrast, there's also in the money. So this is abbreviated ITM. And so it's the exact opposite scenario as out of the money. Now here, a call option strike price is below the share price, and a put option strike price is above the share price. Right? Previously, it was just vice versa. Call option was above, put option was below. But in the money, call option is below, and a put option is above. So let's look at the options chain to see where these would happen. Okay, so if we look at Apple's call options, for in the money options, we want the strike price to be below the current share price. So all of these are in the money for call options. Now on the put side, if we click on put, everything that is above the current share price, these are all in the money put options. All right, so what does that mean? What does in the money mean? So an in the money option, these options would have both extrinsic value and intrinsic value. So the extrinsic value we talked about, this was the time value or the time left in that options contract before the expiration, as well as the implied volatility that boosts the options premium or the options value. But intrinsic value also includes the price of the stock minus the strike price. So the in-the-money options have these three things: the time, the volatility, and the current value of that option because it's actually worth something. So let's go back to the options chain where we can explain it maybe a little bit more in depth. Okay, let's look at a call option. This one probably will be a little bit easier. Okay, so with the call option right here, everything that's below, the strike prices are below the current share price, these are all in the money. So let's just use this 145, for example. This 145 strike price, it has time left because this does not expire until August 6th, which is about 7 days away. It has volatility. So if we click on here, we can see the volatility. There's 20.2% of volatility. That's not terribly high, but there is still some in there. So it contributes to the options price, the time until expiration, the implied volatility. But we've also got intrinsic value for these in-the-money options. So what that means is when you buy a call option, so let's just click on this. Click on continue. Let's review the order just to see what it says. So if we buy this call option, it says this: you're paying $198, that's the options premium, for the right to buy 100 shares of Apple for $145 per share by August 6th. If Apple shares aren't $145 or higher on August 6th, this option will expire worthless. All right. So what this means then is if we buy this particular call option, we have the right, because we hold this contract, we have the right to buy Apple at $145 per share. Notice that Apple is currently trading at $145.95 per share. So if we were going to buy it at $145, but Apple is currently trading at $145.95, that means we would buy Apple cheaper than what it's currently worth. So this 95-cent difference, we're buying Apple 95 cents cheaper than what Apple currently is. This 95-cent difference per share, that's the intrinsic value. $95 is intrinsic value. So of this $1.98, 95 cents is intrinsic value. The $1.03 left over is time and volatility. Now, how much time is left here? Well, we can see from the Greeks down here. And if you don't know what the Greeks are, I'll put a link in the description below so you can watch a video on an overview of option Greeks. But one of those is this theta. So this is time's negative effect on options values. So we see that theta is negative 0.12. We're just rounding to 0.12. Now that means this option will lose $12 or 12 cents per share. There's 100 shares. It will lose $12 per day. There's approximately 7 days left. So if we look at this options contract right now, and I'll just pull up the calculator, we've got $1.98 minus the options intrinsic value, 0.95, minus the theta, which is 7 days times 0.12. That leaves about 19 cents of volatility. So this is a part of how options prices are calculated. We can look at the intrinsic value and we can look at the extrinsic value. So in the money, options are always going to have that intrinsic value, and that's the difference between the current share price and the option strike price. All right, so that's in the money options. They've got time, volatility, and the intrinsic value. Now, at the money options, abbreviated ATM, are simply those options that are near the share price. The strike price is near the share price. So for a call option, the option strike is near the share price. So for a put option, the options price is near the strike price. So like the out of the money or in the money options, these at the money options will have extrinsic value, but they may or may not have intrinsic value depending on if they're in the money or not. All right, so coming back to Apple, you can see the current share price is $145.95. So the option strike price that is closest to this is the 146 strike price. This would be at the money option. And that would be the same for the call and for the put. It's the closest strike price to the current share price. So that's what is referred to as an at the money option. So if you have any questions about this topic or about selling options in general, just leave a comment down below and I'll answer it as quickly as possible. In the meantime, if you want to learn more about the wheel strategy and how I use it for lifestyle trading, click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.